There is a widely held assumption among working professionals that income is the primary variable in building financial security. By extension, a second source of income, commonly referred to as a side hustle, is treated as a reliable mechanism for accelerating that security. The evidence does not support this assumption. The majority of individuals who generate supplementary income do not accumulate wealth at a rate proportional to that income. They work more hours, they earn more, and their financial position does not materially improve. The cause is not laziness or poor discipline. The cause is structural. More income does not automatically produce more wealth. That distinction is not semantic. It is the central problem. Section 2. Problem exposure. Why common advice fails. The advice to generate additional income rests on a logical premise. If expenditure remains constant and income increases, the surplus grows. In practice, this model fails for two compounding reasons. First, expenditure rarely remains constant when income increases. Lifestyle expectations adjust, often gradually and imperceptibly, to absorb the new income. This is not a character flaw. It is a well-documented behavioral pattern that financial institutions and consumer markets are specifically structured to encourage. The credit available to you expands as your income grows. The products marketed to you shift upward in price point. The social environment of a higher earning professional carries implicit cost pressures that did not exist previously. Second, the additional income generated through supplementary work is frequently unstructured, meaning it arrives without the automatic allocation mechanisms that some employment income carries, such as pension contributions or tax withholding. The result is that it enters a spending system that is already optimized for consumption, not accumulation. It disappears without being directed, and no record of its disappearance is examined. Perspective shift at 102. Insight 1. The expansion of earning capacity does not neutralize structural leakage. Most professionals carry financial structures that extract value continuously: interest-bearing credit balances, depreciating asset loans, and service contracts with escalating terms. These structures do not pause when income increases. They continue extracting at their contracted rate, irrespective of the earner's financial activity elsewhere. The implication is that additional income directed into general spending, rather than toward the elimination of these extractive structures, produces no net gain in financial position. The additional labor is absorbed by existing liabilities before it reaches the asset side of the ledger. Insight 2. Time has a financial cost that income calculations ignore. Supplementary income is always purchased with time. That time carries a cost that is rarely quantified in the decision to pursue additional work. The hours invested in generating secondary income are hours not available for financial architecture, the structured review of existing liabilities, renegotiation of recurring costs, or deliberate capital allocation decisions. Beyond the opportunity cost of time, there is a cognitive cost. Sustained overextension of working hours reduces the analytical capacity required to make sound financial decisions. The fatigue produced by additional work is itself a financial liability, because the decisions made under that condition are less precise than those made from a position of adequate capacity. Insight 3. The velocity of money matters more than its volume. Financial accumulation is not determined solely by how much enters the system. It is determined by how quickly value leaves. A professional who earns a moderate income but routes it with discipline, directing every unit of surplus toward liability reduction or compounding assets, over time will outperform a higher earning professional whose income flows through an unstructured spending system. The side hustle narrative is built on the premise that volume solves the problem. In most cases, the problem is not volume, it is velocity, and velocity is a function of structure, not income level. Section 4. Practical framework. The framework that follows addresses the structural preconditions for supplementary income to produce actual accumulation. These steps apply regardless of whether supplementary income is already being generated or is being considered. Step 1. Quantify the leakage before adding volume. Before directing effort toward generating additional income, calculate the current rate at which value is leaving your financial system. This includes interest charges on all active liabilities, depreciation on financed assets, and annualized cost of all recurring service contracts. Express this figure as a monthly total. Why this works? Supplementary income applied against identified leakage produces a guaranteed calculable return. Supplementary income applied into an unexamined spending system produces no measurable return. The calculation determines which scenario applies. Common pitfall: calculating only the nominal cost of liabilities rather than their effective annualized rate, which understates the true cost of carrying them. Step 2. Establish a separate allocation account before earning begins. Any supplementary income should flow into an account that is structurally separated from primary spending. This account has one function: directed allocation. It does not function as a spending account, a buffer, or an emergency reserve. It is an allocation mechanism, and every unit that enters it is assigned a destination before it arrives. Why this works? It removes supplementary income from the spending system that is already proven capable of absorbing it. The structural separation creates a decision point that general account management does not. Common pitfall: establishing the account without a predefined allocation rule, which reverts the behavior to general spending within 1 to 2 pay cycles. Step 3. Assign every unit of supplementary income to a specific instrument. Each allocation from the separate account should be directed to one of 3 destinations in order of structural priority: high-rate liability reduction, then low-cost liquid reserve building to a defined ceiling, then compounding asset instruments with a defined time horizon. No supplementary income should be unassigned. Why this works? Unassigned income does not remain unspent. It is consumed by the ambient cost pressures of daily financial life. Assignment is the only mechanism that prevents this. Common pitfall: allocating to investment instruments before high-rate liabilities are resolved, which produces negative net return at the portfolio level. Step 4. Review allocation efficiency quarterly, not annually. The financial conditions that informed the allocation structure will change. Interest rate environments shift. Liability balances